and welcome to the Business of Property podcast. I'm Stuart.
And I'm Simon.
We're both property people running our own businesses, and this podcast is just us chatting, as we often do, about anything and everything property. And we've been very fortunate recently that we've received an email. We've received some communications from people that are listening, so thank you to those people. But we've received a specific email from Alexander Gold that asked us around why decisions were made around where both Simon and I have started investing, why we picked on the location, why the strategies, that kind of thing. So both Simon and I thought, well, what better way to kick off the year really by going through those things and talking through our rationale about why we made the decisions we made. So obviously, Simon, we've got differing strategies, which I think from my perspective makes this a bit more interesting as well, because we've got different takes on why we do what we do. But before we get into locations and everything else, I guess it would be remiss of us not to talk about why we both ended up doing property. So with you, why did you decide to purchase a property? I think for those people that are listening, we'll know a little bit about the wider PIFA story. But maybe just for those newer listeners, talk about what got you into property and why property for you.
We did do some sort of backstory episodes a long time ago, so I will mention them here as an excuse to link to them in the show notes. So if people want the wider backstory from both of us, then they can have a look in the show notes and go back and listen to those episodes. For me, though, property has been an interest for a long time. I like looking at properties. I like looking around properties. I like imagining what be done to properties to improve them, and potentially even sort of create them, if you like. I'm not. I don't have the time to put into the property process at the moment to really go from the beginning to actually build and create. But maybe one day. So for me, it's really an interest in property, and the added bonus on top of that of being able to make some money and make an income and investment revenue from that. So I sort of felt, as I was sort of a young adult and moving into work and things, I sort of felt that I would always get into property. It's just something I wanted to do. It wasn't really, it definitely wasn't my career, and still isn't my sort of sole career. I've been in sort of technology and software a lot more, but it is something that I just always wanted to do and just always assumed I would do, sort of as part of my life, really, I guess. So how about you, Stuart? Yours was a bit later in life, I think, wasn't it, that you decided to set your sights on property?
Yeah, much later. I would say late 30s and beyond. And mine's probably a much more mercenary tale than yours. And essentially, when I was looking for additional replacement streams of income, i.e. what could replace my annual salary, it was looking at a number of different things. And my journey was looking at franchises, looking at other businesses, and getting to the stage where I realized that for a franchise, for example, when I looked at retail, things I was interested in, I realized that it would probably be longer hours, more days than I was currently working. And as a lot of us do, started looking into property. And for better or for worse, there is a lot of information about property investing on the web. And you learn to, I guess, filter a lot of it as you develop. But as we discussed previously, I landed on property for a couple of reasons. Number one is the fact that the asset is more likely going to be an appreciating asset, i.e. hopefully worth more than you pay for it at the end of the term, if you're thinking long term, and the ability to generate cash flow. We talk a lot about passive income in property. I for one think there has to be a huge caveat with passive income, because I think it takes a lot of effort to get this passive income, a real lot of effort. But that's why I ended up on it. So essentially, it was really about how could I create an additional income stream and eventually a replacement income stream, which would keep providing for me. And property was the one that really I liked. I think just providing people another view on other things I've looked at and have invested in stocks and shares, something I would do. But for me, again, they're very long term. And a little bit like you, I think I quite like the tangible nature of property, the fact that we can go in and, as listeners will know, I've just done a property recently which is very design led, but the fact that we can go in and touch the walls and make changes to it versus stocks and shares where it's a little bit sort of intangible to me unless it's a business I really know well, like if it is an Apple or a blue chip company. So they're my key reasons.
Yeah, I think if you look at it just from an asset class sort of point of view, a mercenary point of view, as you mentioned, it does have that benefit of being physical. People will always need somewhere to live, and if you're buying freehold, particularly as well, you get a bit of land. They're not making any more land, so actually in some places they are, but anyway, generally speaking, they're not making any more land. So once you've got that asset, it's a fixed, physical, tangible asset that isn't going anywhere and is secure. Whereas, as you say, stocks and shares are really very much imaginary. Maybe that's going a bit too far, but they don't have that real link to the real world. So I think that's a real benefit to property as an investment class.
But and as we're talking about it, I can also hear alternative arguments. Obviously, I read a fair amount now in relation to investments, and I can also hear people saying, "Yeah, but once you've got a property, you've got all of the costs associated with that versus buying into a company." And I was reading recently of some stocks that were picked last year that are worth 4 times as much, and I'm sure there's greater prizes to be had out there. So there will be arguments, but I think our rationale and people that listen to this show will probably sign up to the fact that the tangible nature and the fact that it's something we feel like we can do something about or change helps us a lot as part of a portfolio.
Yeah, exactly. As you say, if you bought into a company in stocks and shares, yes, you don't have the maintenance, but then you also don't have the control that comes with property and having the responsibility to maintain it and look after it. So it's swings and roundabouts perhaps on that area, because obviously the maintenance has a cost and a responsibility as well. But I suppose people could look at getting into property funds and things like that if they wanted to invest in an asset class that has that sort of physical backing, but they don't personally have the responsibility for looking after it. Have you looked at that at all?
Well, I think you've just touched on one of the key things around why people might not like property as much as we do. Is the posh term for it is illiquid nature of it, but it just means that it's not so easy to get your money out of the building, which I can certainly attest to. And that's probably one of the things, is that if you yourself are buying into the property, other than the refinancing element of it, it's going to take time to get your money out. I mean, we're talking, as some people might know, I'm trying to sell 3 properties right now. So the money that I want out of those properties is we've been waiting a few months, and we're going to wait probably several more before we see that cash. Versus the property funds you've talked about, I think there will be criteria around having to wait a certain amount of time, but you can probably have more of a say in when you get your money out. And of course, if you're just buying shares, you can do that on a minute by minute, hourly basis, should you wish.
Although you've got to have someone who'll buy them off you. There are 1,001, I'm sure, different property sort of investment options, if you like, if we're, as opposed to actually buying the physical property. I mean, so sort of investment vehicles and things, you can buy them through pension type funds, but they're also crowd-funded and that type of platform. And there's one platform that I'm familiar with and have invested a tiny amount with just to experiment with. This is a long time ago and I can't actually remember what it's called, but I'll try and remember and look it up and put it in the show notes. But having put some money into this investment fund process, whatever it was, I gained a few shares of a particular property that's in their portfolio. And I can now go onto their platform and I can offer those shares up for sale at a certain price. And I can also see if there are people already offering for shares in that particular property at various prices. But if we don't meet in the middle, if I want more than there is anybody willing to pay for those shares, then I can't sell them. So while the money might be more liquid than actually owning a property, it's still not totally liquid. You've still got to have someone willing to pay you for it to be able to sell it.
Mm.
And I assume really that works for all shares, doesn't it? It's just that most shares in big companies or even smaller companies that are traded on open markets, the assumption is there will always be someone to buy it.
Yeah, at the right price.
Exactly, that's what I was going to say. It requires going to the price that the market is offering rather than necessarily the price you want. So, yes, I don't know. So when we actually invest in property, there's lots of different ways you can invest in property. But I suppose perhaps just as a starter, would you recommend that somebody should get into property as a get rich quick process? Do you think?
I think you and I are very much aligned on this, and the short answer to that is absolutely not. It's not get rich quick, and we've touched on it there. If you're looking to cash out and you're in property, it's going to take time. So therefore, to accrue that cash itself will take time. And I've been a landlord for over 13 years, and had a property business for well over sort of 4 years now. And I must admit, naively, when I first started the business, I thought we could build significant incomes. And it's not to say that you can't, depending on your level of funds that you're going in with, but typically I would say it's going to take time, because that is the nature of the sector, property sector. Property takes time. Purchasing property takes time. Developing property takes time. And therefore, making money takes time. And of course, there's going to be people that talk about strategies, flipping, rent to rent, other very or much shorter timescale, let's say strategies. I'm not a big fan of that word in this sense, but strategies like that. But having done all of those myself, I can say that they all take time, and they all take longer than you think. So I think if anyone's thinking, I can replace my salary, unless you've got a really small salary, and that would be great, unless you're trying to replace a few grand a year or 10 grand a year, or on the other side of the fence, you've got significant amounts of capital, in which case you're probably looking at alternatives anyway, then I think it's going to take a bit of time. What that timescale will be will depend on what your strategy is, what terms of property investment criteria you're going to set.
If you're looking at property as a wealth creation or an investment vehicle, it's not sensible to be looking at it as a get rich quick. You're not going to start investing and be a millionaire, but if you're starting small, you probably wouldn't expect that straight away. But anyway, you're not going to see the returns very quickly. You're going to need to be working on the investment and the process for at least months, probably years, before you actually see sort of decent returns from it, unless you're going in with a lot of capital to get started on. And even then, it takes some time just to buy properties and to get processes up and running and get tenants and whatever else. So even if you've got the benefit of capital to make your investments larger to start with, it's still going to take some time. So it's definitely not get rich quick.
So my experience, and I don't mind being a bit more transparent about this. So I got funding, I got investors, and I can say comfortably we created a multi-million pounds portfolio. Or multi might not be quite right, but it's more than a couple in terms of total portfolio assets. If I was saying a course, that's a great line to have. But a lot of that is mortgaged because we are highly leveraged. And a lot of that cost a lot of money to redevelop. So in my mind, although we were moving quite quickly, and we did move quite quickly, it took significant funds to do that. And of course, when you're borrowing from the bank, that costs money. If you're using investor capital, that costs money. If you've got your own money, okay, that's fine, but you've still got to spend it. One of the truest lines I ever heard, and I think about almost daily, is that you will never have enough money in property. And I found that so. I mean, it's just one of those things. It's so true. It makes me smile, but wryly, because I don't think it matters whether you've got 10 grand, 50 grand, 100 grand, or 500. That can disappear very, very quickly in property. And what you and I can both get on soapboxes on certain subjects. One of mine will be aligned to the cash out. Now, I try and do that on every development, of course, because who wouldn't want to have all of one's cash back out of an investment and say that that is now generating the income? I've bought close to 10 properties in the last couple of years, and we got close to cashing out on a couple. In fact, one valued up so that we would actually come away with more money than we put in. But the bank, seeing the margin of what we bought it for and what it was then valued at. So we bought at 540. It was then valued at 735, and we didn't spend that much money on it. They then wanted to de-risk it. So they said, okay, we're not going to give you 70% loan to value. We're going to limit your loan to this amount, which meant we kept money in. So the point I'm making here is that, yes, it's great to have cash out, but my experience as well is that once we got hell bent on trying to do that, we probably made decisions which we shouldn't have made. We should have just made better decisions for the long term. And just the final point, while I'm on this little soapbox, is that strategy that you've talked about in terms of, being get rich quick. I think when we get too short termist, and when I say when I've been very short termist on this, I've made worse decisions than I would have done had I started thinking about it as more of a longer term play. And when I say longer term, I'm thinking 3 to 5 years. So I think for me, that is one of my biggest learnings since I've started the business, is actually, instead of making decisions for the short term, I now make them for the long term. So for example, the property that we just developed and spent over 50k on, which I already owned, I bought that in 2015, but was becoming dilapidated because we didn't spend enough on it. I said, okay, I'm going to spend some money on it. We can get it revalued, and we'll probably get 90% of those refurb costs out. But I'm not spending the money for that. I'm spending it to protect the income for the next 5 years and to protect the occupancy, which is a very different decision to how can I refurb this property for as cheaply as possible to get as much money out as possible, so that I can say it's a cash out and it's a full investment. So that's changed some of that thinking. So just wanted to share some of my experience around that, because I have fallen into that trap. So feel sort of able to talk about that.
Yeah, I think it's very important experience to share. It's very useful. So if property is not get rich quick, it probably is a good way to build long-term wealth. It can do other things as well, but the hope is that as part of the parcel, you would get capital appreciation over time, and that can gradually increase your wealth. This varies quite significantly with location, though, and we don't have time to veer into location too heavily today.
Because I've got another soapbox for that as well. But
okay, definitely save that one for next week, or maybe the week after. We've still got lots of notes to get through. However, if you can invest in the right place where there is capital appreciation, property is an excellent way to build long-term wealth. Property rarely goes down in value. Even in areas that don't grow as quickly, it's still fairly rare for it to actually go down in value, except in sort of specific periods of economic turmoil, and then it generally recovers again. So it's a good way to build value, and it's a good way to normally build value faster than inflation.
Can I just make a point on that one, Simon? Because
yeah, please do.
When I started out my investing, I was quite bullish on that as well, and I think very single tracked and single focused in that the the current thinking is typically that property values double every 10 years, roughly, give or take, if we look at it, and typically it has done. And I kind of again went hell bent into my investing, thinking that that was the case. My sort of watch out on this is that now when I'm investing, I don't expect that to happen. It's not a given. Whilst we can look at the last at least 60 years of history and we can see that trend is always upwards, my learning is the investment itself should stand on its own 2 feet. So if it didn't increase in value, would I be happy with the investment? We force value, so we add value into properties. So that's the only thing. Because again, I think my safety net was, oh well, it'll be fine because if I make a couple of mistakes, this property is going to be worth double. And that varies on region because it has for my property in Southwest London. It won't for the properties in Southwest UK. Some will be slower, some will be quicker, depending on region. So the only caveat I'm adding to that is just don't expect that. It's going to be a nice thing that happens, but don't factor that into investment criteria.
Yeah, I completely agree. Where I was heading with this long-term wealth growth thing that I'd started with was really that while that is generally what happens, and generally, well, yeah, it's generally what happens. It at least sticks with inflation, normally just beats inflation. In certain areas, it significantly beats inflation, historically speaking. And that's a great perk to property investing. But personally, I don't think it should be the core of property investing because, as you've quite rightly said, it's historically been that way. That doesn't actually necessarily mean going forwards it will be. And you've got the complexity of location, which we'll talk about another week. But there's, depending on how you play the location card and choice and whatever, you may not be, your investment patch just may not have that characteristic of beating inflation, or at least not significantly beating it. So while property is probably a safe store of wealth and may well beat it, so it may well grow it well in the long term, I wouldn't recommend relying on that. And I know some people do. Some people invest specifically as or for capital appreciation, and as you said, I think that's a little bit risky. I think every deal, as you say, should really stand up on its own. So it should produce ongoing cash flow revenue without the need to fall back on the capital appreciation.
Yeah.
One perhaps sort of caveat I should put in here is I'm not talking about flip projects, which is where you, as you said, sort of you force an increase in value to the property and then sell it on based on that capital appreciation. I'm not really talking about that. I am only really talking about the natural long-term capital appreciation. Because of course, investing in flip projects is another very specific type of investment and sort of approach, and that does effectively produce a shorter term and specific revenue, assuming they go according to plan.
Yeah. So one question I just had for you, because our approaches are quite different. So I would consider my approach is more, relatively speaking, more short term than yours, just because I'm looking for quicker cash flow. Although that's still a main criteria of yours, obviously, is cash flow. But when you're thinking about your outcomes, your expected outcomes, when you go into investments, what are you thinking about?
I might be thinking about a number of different things depending on what I'm expecting to do with the property in this relatively short term. So I might be looking for a property that I'm going to refurbish and increase in value in the relative short term. And that might be slightly different to if I'm buying a property, for example, that's already got a tenant in it, which I know is going to be producing revenue from day one. However, I've never yet gone into a property purchase expecting to refurb and refinance. So I've never planned to do it on that shorter timescale. I have bought properties that I've held for a couple of years, the sort of standard fixed term period, and then refinanced and taken money out of that property again, or taken further money out of that property to then roll again into a new property. But it's always been on that longer time period. So in the short term, I'm definitely looking for rental revenue that produces profit above ongoing expenses. And my key calculation for that is really return on investment, ROI. So I look at all of the money that I put into a deal and all of the profit that it's going to produce for me. So rental revenue minus expenses. And that's really the key measure that I go with.
Yeah. And as far as you're concerned, you think about holding those for anywhere from sort of 5 to 10 years plus.
Yeah, my assumption going into property purchase is not to think about the sale. The intention is just to hold. I don't go in thinking that I'll hold this for 5 years or 10 years or 15 years or 20 years or 30 years. It's just buy and hold forever. Is the sort of starting assumption. And of course, that may not remain the case. As case in point, I've recently sold a property. So if things move around and it works out better that property should be sold, then I will. But going into a deal, the expectation from me, the assumption is that I will just hold it forever.
Yeah,
I think that's very different from your approach, isn't it, Stuart? You have much more of a exit plan in place from the beginning, don't you?
Well, in terms of the buy and hold, I mean, that is very much my approach. So we never intend to sell properties, but equally when we need to. So we look at, I would say 90% of what we do is about buy and hold. So the properties we buy, I don't intend to sell those for at least 10 years. And that's how I look at it. It's like it's going to be a 10-year property. That might change where if we need to release capital. So I'm looking at selling one of our co-living HMO properties at the moment, purely just because there's quite a lot of capital in it if we sell it for the amount we want to. And that would just ease some of our sort of cash flow concerns at the moment. And the big difference versus what you've just talked about is that when we buy, we do look at refurbing and refinancing typically within months of purchasing a property. Yeah, somewhere already on the second set of further borrowing. And that doesn't come without challenges. And, I just add that because once again, if you're looking at courses and everything else, it's BRRR, buy, refurbish, refinance. It all sounds wonderful, but it costs money. It erodes cash flow. So needs to be looked at and modelled. It can all be done, but so that's what we do. We tend to buy a property. Typically, the refurbish will just about be covered by the sort of refinance, but the downside to that is the additional borrowing will eat into the cash flow. That's the difference.
Yeah. On the modelling point, it would be remiss of me not to mention that PATMA has very recently added a BRRR calculator to its to the suite that it offers there. So if you're thinking about doing that kind of deal, the buy, refurbish and refinance deal, then you can have a look at PATMA. You can sign up for free and try it out, and it'll model it all out for you. So you can put in what you're buying it for, and assuming you're going to buy on a bridge, so you can refinance fairly quickly. So it works out all the bridging finance costs, put in your refurb costs and ongoing maintenance during that process of council tax and whatever else, and then what you expect to rent it for in the end, and refinance it for, of course, onto a more standard mortgage. I'll do all those calculations for you and tell you what you'll get out of the end of it, or not, as the case may be.
Well, definitely be using that for my next development.
Yeah, it's so hot off the press. You haven't even had a chance to look at that, Stuart. But yeah, I will. I'll make sure you can access that later on.
Very good.
We are over time again, as normal. so shall we finish up here, even though we've still got a few more notes, and roll them over to the next week?
Yes, definitely. Well, hope everyone's gotten some value from that. And once again, like Alexander Gold, if you have any questions or you're thinking about doing anything in property, do feel free to contact us. You can contact us via thebusinessofproperty.com. There'll be a contact page there. And all of the notes and links that we've spoken about will be on the show notes page at the same location, thebusinessofproperty.com. And we'll see you on the next episode.